Hello, everybody. My name is Brenda, and today I'm going to be covering the Financing East Coast Yachts Expansion Plans with a Bond Issue case. This case is found in the Corporate Finance book by Ross, page 165 of Chapter 5. And in this presentation, we will analyze how different bond features affect the coupon rate. I will also cover the advantages and disadvantages of each feature for both East Coast yachts and potential investors. I will be going over topics A through J, which is going to be covering security and seniority of a bond, sinking fund, call provisions, covenants, conversion features, along with floating rate features. So bonds can be either secured or unsecured. A secured bond is backed by collateral, which reduces risk for investors, and because of this, secured bonds usually carry a lower coupon rate. And on the other hand, unsecured bonds, also known as debentures, are riskier and they're riskier for investors, so the company would need to offer a higher coupon rate to attract investors. Seniority refers to the order of repayment. If the company defaults, senior bonds are paid back first, so they require a lower coupon rate, and subordinate bonds are repaid later and therefore carry a more risk, so they require a higher coupon rate. And now looking into a sinking fund. A sinking fund is an account managed by the bond trustee for the purpose of repaying bonds. The company usually makes annual payments to the trustee, who then uses the funds to retire a portion of the debt. And this reduces the risk for investors because they are more likely to get paid back. As a result, the coupon rate is usually lower. On the downside for the company is that a sinking fund will limit financial flexibility, since East Coast yachts would need to allocate cash regularly rather than using it for other investments. And all of this information can be found on page 142 of the book. And moving on to call provisions, the call provision allows the company to repurchase or call part or all of the bond issue at stated prices over a specific period. Corporate bonds are usually callable. Call provisions are often not operative during the first part of the bond's life. For example, a company might be prohibited from calling its bonds for the first 10 years, and this would be an example of the deferred call provision. This does benefit the issuer, but it does create reinvestment risk for investors, and because of this, investors demand a higher coupon rate. And for example, a deferred call provision protects investors for a certain period by preventing the issuer from calling the bond immediately, as I mentioned previously. Since this reduces the risk for investors, the coupon rate does not need to be as high. Moving on to a new type of call provision, which is a make whole call, has become very widespread in the corporate bond market. With such a feature, bondholders receive approximately what the bonds are worth if they are called, because bondholders don't suffer a loss in the event of a call. They are made whole, which gives it the name. A make whole call provision is even more favorable to investors. The required coupon rate is lower than with a regular call provision. And all of this information can be found on page 143. Now we're going to cover a protected covenant. There are two types of covenants. There is a positive covenant and a negative covenant. A protected covenant is the part of the indenture of a loan agreement that limits certain actions a company might otherwise wish to take during the term of the loan. Protected covenants can be classified into two types, which I already talked about, the positive and the negative. The positive covenant is a thou shalt type of covenant, and it just basically talks about the what the company agrees to take or a condition the company must abide by. Some examples of those are a company must maintain its working capital at or above some specified minimum level. A second example in the book is the company must periodically furnish audited financial statements to the lender. And a last example that they have listed in the book is the firm must maintain any collateral or security in good condition. And then the negative covenant, which is a thou shall not type of covenant, it limits or prohibits actions that the company might take. And some examples of those that are listed in the book is the firm must limit the amount of dividends it pays according to some formula. A second example is the firm cannot pledge any assets to other lenders. A third one is the firm cannot merge with another firm. The firm cannot sell or lease any major assets without approval by the lender. And a last example that they have in the book is the firm cannot issue additional long-term debts. Both types of covenants limit managerial flexibility, and it can be a disadvantage for the company. However, positive covenants have actions that reassure investors and they reduce risk, which lowers coupon rates. And a negative covenant also reduces investors' risk, leading to also lowering coupon rates. But again, going back to the limit of managerial flexibility, they can be a disadvantage to the company. And this information can be found on page 143 and 144. Now, with floating rate bonds, also known as floaters, the coupon payments are adjustable. The adjustments are tied to interest rate index such as the Treasury bill interest rate or the 30-year Treasury bond rate. Because investors are protected from interest risk, they are willing to accept a lower coupon rate compared to fixed rate bonds. The risk for East Coast yachts is that if interest rates rise significantly, the company's interest expense will increase. East Coast yachts could also look into zero coupon bonds, which is a bond that pays no coupons at all, must be offered at a price that is much lower than its stated value. And the advantage to this is that no cash goes out each year. But the disadvantage is that the company will face a larger payment at the end. Coupon bonds, on the other hand, pay interest regularly, which investors like because they're getting a steady flow of regular payments throughout the year. And for the company, it does mean making regular cash payments throughout the life of the bond. And so that's basically the difference between zero coupon bonds and coupon bonds. In conclusion, some of the features of a bond may affect how much interest East Coast yachts would need to pay. Some of these features lower risk for investors and reduce the coupon rate, while others may increase risk and raise the rate. The important part is essentially finding that balance between the borrowing cost and the flexibility that the company should maintain. Thank you so much for listening to my presentation, and I look forward to hearing any questions you may have.